Hello, and welcome to the first of what I hope is many educational seminars that we can send to you all via email. I want to thank you all for being part of the Cunningham Group family, and I'd like to introduce you to my family. I'm Matt McCleskey, and that's my lovely wife there, Alexis. My little boy, the oldest one, is Oliver, and my youngest is Calvin there with the rosy cheeks who has his eyes fixated on the camera. I'd love for you all to meet my family at some point. Some of you I may have talked to in the past. I did work as an intern for the Cunningham Group as I went through school at California State University. If I have talked to you, I'd love to talk to you again. If I haven't talked to you, I look forward to meeting with you. I do want to go through some information with you, but first a little bit about me. So I graduated cum laude with a degree in economics and a minor in political science. I also have a degree in business. I'm a published economic researcher for the California State University. One of those feathers I like to put in my hat. Not too many people get published as undergraduates, but I was able to. I got really into economics, and that really is my passion, and it dovetails nicely with working at the Cunningham Group. Loved working here. This is the best job that I've ever had, and I couldn't stay away for too long, so I did come back, and this is my career path. So I love working with people in retirement, nearing retirement, or just preparing for retirement. And that's really where my passion lies. So I look forward to really working with you all, or at least speaking with you a little further as time moves on. But after school, I did work for years as a data analyst at one of the top law firms that focuses on labor law. My primary work there was with labor statistics and really analyzing those statistics and producing reports for attorneys. And so that is a little bit about me. I am a big nerd, as you can probably tell from the quick synopsis about myself. I explain things with graphs. I'm very math oriented, very number oriented. I love charts, and everything that I try to go through is backed by data, and which can be a lot. People's eyes can glaze over. It's one of those type of things, but really want to go through some of this information with you, and hopefully you can stick with me. We're going to try to make it as concise as possible. And then lastly, I'm a licensed fiduciary, which just means that I'm required by law to put clients' needs and best interest in front of anything else. And we all are licensed fiduciaries here at the Cunningham Group, so something to just kind of keep in the back of your mind. As we go through this presentation, you'll notice at the bottom there is a link for Calendly, and what that is a link to schedule an appointment with us through either Zoom or an in-person appointment. Our number is listed on that or through that link, so you can give us a call, and whatever you prefer to do to get some of this information more in detail, I'd encourage you to do so. So we're going to take a 10,000 foot view of a lot of information. I'm going to throw a lot of data at you in a very short amount of time. So I want you to take notes, and I want to make sure that we set up a meeting to see how it affects your plan in retirement specifically. So click on that link that goes directly to our calendars so you can see what times are available. You can nab one of those times and make sure that that is your time to set up. If you do choose to do a Zoom conference with us, you have the ability to set that right up there, and it will email you a confirmation with a Zoom link in there at whatever time that you pick. So I highly encourage you to do that, just to try to make it as easy as possible to tailor this information to you and your plan in retirement. So this presentation, we're really going to talk about current economic conditions, forecasts, and potential risks, and really in regard to the pandemic that we're all going through. So again, this is going to be a 10,000 foot view, a brief simplified breakdown based on historical data, current data, and economic forecasts. And what this really is going to end up doing is just be a very simplified, and I'd like to highlight that again, simplified breakdown. So there's a lot of different variables that we're going to leave out because we can't analyze every one of them without having at least a 3-hour lecture, and I'm not going to do that to you all. I'm going to try to make this as concise as possible to get the nuts and bolts of the information across so that you have an idea of what we're looking at. And then if you'd like to discuss this more in detail, again, I'd encourage you to set up an appointment with us so we can go through that. I'm a huge nerd. I love talking about this stuff. So if you're the same way, give us a call and we can do an appointment with either Paul Cunningham, Troy Cunningham, myself, or one of the other agents that we have here at the office. So we're going to talk about risks in retirement. I listed them all here. We're not going to be talking about all of them, but the few that we are going to talk about is longevity risk, which applies to all of them. And that's the great multiplier. And we put that there because we don't know what the future is going to hold. We don't know how long we're going to live, and we don't know how long our money is going to last in retirement unless we have proper setup in retirement to ensure that our money lasts at least as long as we do. So that is just one of those multipliers that applies to each one of these other risks. But there's also inflation risk, taxation risk, interest rate risk, withdrawal rate risk, and investment risk. We're going to primarily focus on inflation risk and interest rate risk in this video. And then again, longevity is the great multiplier. So we're going to talk about the COVID-19 stimulus effects and what that does to an economy and what that really does and how that trickles down to the nuts and bolts of this video, which is retirement plans for those that are nearing retirement or already in retirement. The GDP effects, again, how does that affect you, the gross domestic product that's of the nation, and what does that mean for you and why should you even care as an end consumer? The savings rate, how does that affect your retirement account? Inflation on retirement, which we've all heard inflation time and time again. It's in the news. I'm sure we've seen it coming down the road. Some of us might say we've already felt it to a certain extent. We do expect inflation to go up higher than what it is right now, and so pay special close attention to that. Federal Reserve's historical response to inflation. So what does the Federal Reserve do to ensure that the dollar doesn't lose value in comparison to other currencies throughout the world? And interest rate risk. And so how they do that is they increase the interest rate. And so we'll talk about that and how that affects your retirement plan. Consumer effects. And so that's really how it affects the end consumer. So you, me, everybody else that's the end consumer. How does that affect us as a broad whole? And then how does it affect retirement plans? So we're going to talk about the stimulus first. So fiscal stimulus, such as tax cuts or spending increases, can raise output incomes in the short run by increasing overall demand. And so short run is one of those words that I'd like to highlight there because it does work well in the short run. So if the government increases stimulus or injects the economy with money, the idea is that people are flush with cash. They'll go out and they'll spend the money. They'll buy things. They'll go to concerts. They'll do all these different things. Businesses, in turn, will have to hire people or create more goods or services or provide more services or the like. And what that does is it really just boosts the economy. It forces the economy to just jump where it was stalled before. So that's the idea behind stimulus. But in the long run, fiscal stimulus would not increase output, but instead simply crowd out other economic activity or induce the Federal Reserve to tighten monetary policy to keep inflation down. So they do that by increasing interest rates. So the way that the Federal Reserve combats inflation is to increase interest rates, which then tightens monetary policy and keeps inflation down. So again, a lot of information that I'm throwing out at you, but how does that affect you? Well, we want to go into that in more in detail, but let's talk a little bit about the records that we've set over the last year and trickling into this year. So a little over $3.4 trillion was spent on COVID stimulus programs in 2020. Another $1.9 trillion is spent on stimulus programs this year, or expected to, and it's expected to be released mid-March or to the end of this month. So what does that really mean? Well, $3.4 trillion is more than the entire government brought in 2019 on stimulus spending alone. So just to give you an idea of what we're looking at as far as spending goes, that is amazing. That is a record by far, multiplied by a lot. That is a huge, huge record. And $1 trillion, when that's spent, that is not a small amount. That is not something to bat an eye at. That is something to keep an eye on, because that will affect all of us. And so I want you to pay special attention as we go through how that's going to affect all of us in the next slides. So I said that I like to explain things in graphs. If you don't like graphs, try to stick with me here. We're going to go through it briefly. If you're a big nerd like me, you love graphs, we can go over it all day. Set that appointment with us. We'll go through that in detail. If you're interested in what we go over on this, give us a call. I can go through and I can go through another economic lesson on how this all breaks down a little bit further in detail. But we've all heard supply and demand, right? So this is going to be the goods and services market. And what we're going to do is we're going to show how inflation, or why we expect, and top economists and other financial gurus that you've probably heard expect inflation. This is graphically how that breaks down. So we've heard supply and demand. Demand goes downward because as price decreases, the willingness and ability of people to buy goods and services at a certain quantity goes up. So that's all that's saying. Supply is inversely related, meaning that as price goes up, the willingness and ability to supply goods to a market goes up. So that's where that goes. And where those two cross, suppliers and demanders can agree on a price. So that's the natural market equilibrium where price is set, is where those two cross and those two can agree on a price at a certain quantity. And that's what we're illustrating here. But what we want to see is going back to that previous statement where I said the purpose of stimulus is to increase demand in the short run. What we expect to happen is for demand to go up or shift rightward. And so when we see that going and shifting rightward, that just means that the economy was injected with a lot of money. We've had I, and probably everybody listening to this has had some sort of deposit in their account from the government through stimulus, and now we have the ability to go out and spend. And so we should be enticed to do so. We're not, because largely there's shutdowns, there's reduced staff orders, stay-at-home orders, those type of things which are keeping people at home. And as a nation, we're less productive than we were before the pandemic. So the supply of goods and services in the goods and services market shifts left because there's less available in the economy to really supply anything to the economy. So this is really what we're seeing as far as market forces in the goods and services market. And so that increases price at the same quantity, or roughly the same quantity. Again, this is just a brief overview of how inflation works. So price goes up and you can afford the same amount of a quantity, so your purchasing power decreases. It means that your dollar today can purchase less than it did yesterday. And so what does that mean? Why is that important in retirement? Well, you probably are already like, duh, Matt, of course that's important in retirement, because a lot of us are dependent on a certain amount of income that we are set up for. And as inflation increases, well, that really reduces our purchasing power for healthcare, for food, for gas, for everything. And of course, that's gonna that can reduce our quality of life. So pay attention to this as we go through. We're going to go through some data points that support this, but again, why we should pay attention to it, especially nearing or in retirement. So the pandemic effect on GDP, I want to point over to the graph here on the right-hand side where GDP had decreased by 3.5%. Doesn't sound like a whole lot, but when we consider that that's the biggest decrease in GDP since the end of World War II, that's a huge, huge, huge point. Another record since the end of World War II that we've set in a decrease in GDP. So real GDP is what this graph is looking at, and real GDP just means that it's adjusted for inflation. So real GDP decreased by 3.5% in 2020, compared with an increase of 2.2% in 2019. So really, that's just a huge, 5.7% shift in GDP, and that really goes into that supply line moving left that we saw on the graph earlier, and another key indicator of why we expect inflation to hit us, and hit us, with a pretty decent impact. So let's take a look at haven't we seen a noticeable rise of inflation yet? And some of you may say, Matt, I'm seeing it right now. I've seen inflation. Things cost more than they did last year, and it's already here. We've seen it. We do expect it to be a little bit higher than it is and increase more than it has already. But why haven't we really seen that increase? Well, because consumer confidence is down. So that's holding that demand curve back a little bit. So it's not moving to the right as quickly as it would if consumer confidence remained the same. So I'll highlight this graph here, and this is the consumer confidence graph that's put out by the OECD. Very reputable statistics company. So this is what we're looking at here is the lowest amount of consumer confidence in a very, very, very long time, and really historic lows as of March 2020. So it is starting to creep back up at a very slow rate. You can start to see that it's tapering off there. Consumer confidence is still down because we don't know what tomorrow is going to bring. People don't want to go out and spend all their money because we don't know what tomorrow is going to bring, and you may need that money to pay for food and housing and everything else that's a necessity. So we're not going to go out and buy a ton of consumer goods with our excess money because we don't have the confidence in the market that that's going to be okay to do. The other thing is shutdowns largely remain. So that means that people don't have the ability to go out and spend money as they once did because there's less places to go spend money at. You can shop online, which that is a good resource, and that has gone up quite a bit, and we've seen that in the markets, that online retail has gone up. But otherwise, your ability to go out and spend money is down because shutdowns largely remain. Sticky prices. So sticky prices is a silly economic term that just says that prices are stuck to contracts. And so as contracts release and their terms end, then they get renegotiated at either current or projected market rates. But they are stuck to those prices until those contracts end at either an annual rate or a 3-year rate or whatever the case might be. And so our prices are slow to catch up with real economic forces due to sticky prices. Also, we can see that traditional pricing holds that back, and as those traditional pricing barriers start to lift, then we can start to see that inflation will come more and more as those two factors start to lift as well. And so what does that mean? Well, you might say, I don't know. People don't have the money to spend. People can't go out there and spend a ton of money like you're saying. Well, let's take a look at the savings rate. The savings rate hit an all-time, again, another record high, and we've set in 2020 more than we have in recorded history at 33.7%. And so that means that people are holding on to their money, they're saving it, and they do have the ability to spend. So as that consumer confidence starts to go up, people can and are able and willing to go out and spend their money, which then makes things more expensive. Demand for goods and services goes up, and the supply still is struggling to come back, which means that or respond appropriately to the demand, which means that inflation goes up. So that's what we're looking at, and another key indicator that I want you to pay attention to. So there's a tremendous uncertainty and virus fear that is lingering, and that is restraining people's desire to go out and spend as they normally would. And so that is the chief U.S. economist at Oxford Economics. Also wanted to point out a statement that says that the previous record for savings was 17.3%, and that was towards the end of the Vietnam War in 1975. So we've almost doubled that. Again, another huge record that we've set, and something to pay attention to because these are massive economic forces, and they do tend to trickle down to the end consumer, but at a slower rate, and it is not instant. So what's the risk to retirement? And that's really what we're here for, right? Is to talk about how does this affect you? There's a lot of stuff that's out of everybody's control. How does this affect you? Well, let's take a look at what it does to retirement plans. So inflation eats away at your purchasing power. We've talked about that. So your dollar today can purchase less than it did yesterday. And that continues to happen. And if you're on a fixed income or you get an inflation, you have maybe some sort of inflationary protections on your plan, are they sufficient to protect your plan against inflation that could go pretty high from what we expect to happen? So that's how it affects retirement plans. We're going to skip that point. If your retirement plan does not have sufficient hedges against inflation, it may negatively impact your expected quality of life, because again, we already talked about your purchasing power going down, and that does that by making things like food, gas, utilities, things like that more expensive. So we want to pay special attention to that. If your plan is not set up to have a safety net against inflationary forces, we highly encourage you to come in, talk with us. We have a lot of different tools that can help your plan hedge against inflationary forces, and they're not all right for everybody, but there is a tool out there for everybody to hedge their plan against inflation. So I'd highly encourage you to talk with us, get a plan review put together to make sure that we have those safety nets set up for you, and that we can protect your plan against inflation. I like the term comparing apples to apples. So just to kind of illustrate this a little bit more concretely, I'd like to point out apples to apples. So that's what we're going to compare. In 1950, a pound of apples cost 9 cents. So for $1, you could buy 11.1 pounds of apples. A couple bucks, you can start yourself an apple pie business in 1950. In 2020, a pound of apples costs $1.30. So for the same dollar, you can buy 0.8 pounds of apples, which means you could bring an apple to lunch like 3 days out of the week, and that's about it. So no apple pie business there. And so this is the inflationary forces, obviously, on a food item, but to really illustrate the impact that inflation can have, we want to make sure that you're protected from that. So what is the Federal Reserve's response? So we see inflation coming. It's talked about all the time. What does the Federal Reserve do historically in a response to inflation? Well, what they do is they increase interest rates. So they try to maintain a 2% level of inflation. And what that does and why they try to do that is it means that our economy is growing at a pretty steady level, that our money is not being devalued in comparison to other currencies at any sort of rapid rate, but that our suppliers and demanders are moving the economy and continuously growing. And so that's the goal that the Federal Reserve likes to keep. So they try to maintain that with either a proactive or reactionary policy, and they use that policy by really their biggest tool and almost only tool is to increase and decrease interest rates. So what they do is they tend to increase interest rates. So if inflation creeps up past thresholds, the Fed increases interest rates. And we could see that throughout history, but what that does is it tightens that monetary policy or monetary supply, and it allows for the dollar value to remain relatively high in comparison to other currencies. So what they want to do is they want to restrict the amount of money that's in the economy and create scarcity of money so that the value of the dollar continues to stay high. So increased interest rates have a variety of effects. A few that we're going to talk about is it entices the private sector to save versus invest, and it decreases home values. The price of houses are really the listed price plus interest rates. Listed price decreases to compensate for increased interest. So people tend to buy payments, not really house prices, and so what happens when house prices become more expensive because of interest? Well, the list price takes the hit, and that's where we kind of see the value of housing go down as interest rates increase. So we'll talk about this a little bit more in depth, but the private sector likes to save versus invest. We can already see that in the bond market currently as bond prices tend to go up. investors are shifting over to purchase bonds versus stocks, and so that's what we're kind of seeing right now. I'd like to highlight the housing market over here. The housing market is one of the key indicators that the Federal Reserve likes to use in terms of seeing what inflation may or may not do. And so we'll take a look at here. So highlighted in red, I'm going to kind of show you the average 30-year fixed interest rate, which has gone down for quite some time. And then I'm going to try to highlight the house prices, which have gone up for quite some time. And you can start to see that there is largely an inverse relationship. So as interest rates decline, housing prices go up, and vice versa happens when interest rates increases, houses prices go down. And you can see this little bubble here, right? Let me highlight it in yellow. Maybe yellow is not a good color. Let's do dark blue. So you can see this little bubble right here, and you say, well, those are working together. What's going on there, Matt? Well, that's 2008, and where those touch, boom, that's your 2008 housing crisis right there. So otherwise, if a healthy market is working the way that it should, and you don't have a bubble, you've got interest rates that work inversely to housing prices. So a lot of us have had an increase in our house value over some time. Over the last few years, and especially here in Colorado, we've seen housing prices go way up. So what I'd encourage you to do is call us, see if we have some tools that can protect your home equity and allow you to retain some of your home equity should interest rates increase as a Federal Reserve response to inflation. And so we have some tools available to protect your home equity that you've built up over that period of time to protect against inflationary forces, or interest rate increases. So the Federal Reserve statement is something that I want to highlight. So the ongoing public health crisis continues to weigh on economic activity, employment, and inflation, and poses considerable risk to the economic outlook. The committee decided to keep the target range for the federal funds rate at 0 to 1/4% and expects it to be appropriate to maintain this target range until labor market conditions have reached levels consistent with the committee's assessment of maximum employment and inflation has risen to 2% and is on track to moderately exceed 2% for some time. And I point this out because what this really means is that we can see that the Federal Reserve is going to take a reactionary approach to inflation as a proactive approach, is really what they're saying here, and that our inflation rate has been fairly low, so they're going to allow that to increase to exceed 2% for some time. So something to pay attention to what policymakers are really doing and how what that means for you and what we can expect to see based on these statements. So we're going to talk further about interest rate risk. We talked about what it does to your house price, but what does it do to the stock market and things like that? So I just want to make sure that all of your plans are able to weather a contraction in the market and or home equity. And again, we have many tools to allow to help for that and hedge against those risks. But we want to talk about a little bit further about what it does to the stock market. So when the interest rate for credit cards and mortgages increase, the amount of money that consumers can spend decreases. So again, people are going to spend less in the market, which is the whole idea behind interest rate increases. Again, it's going to fix those inflation problems a little bit, or at least protect against inflation and keep that dollar value high. When consumers have less discretionary spending money, businesses' revenues and profits decrease. Companies may not borrow as much and will pay higher rates of interest on their loans. It may curtail expansion plans or new ventures or even induce cutbacks. There may be a decrease in earnings as well, which for a public company usually affects its stock price negatively. With lowered expectation in growth and the future cash flows of a company, investors will not get as much growth from the stock price appreciation. This can make stock ownership less desirable. Furthermore, investing in equities can be viewed as too risky when compared to other investments. And when they say other investments, you keep in mind that when interest rates go up, other investments are conservative investments, savings accounts or CDs or again, things that are dependent on, or where returns are dependent on interest rates. So as those go up, stocks become less valuable, decreases. The stock market kind of puts us into a little bit more of a bear market. Traditionally, we still see a growth, but it does have people pull out of the stock market. So if a large portion of your retirement plan is based on the stock market, there are some stock plans put together that do better during bear markets than they do otherwise. And so we do have some tools to hedge against the interest rate risk, if that's something that applies to you. So again, one of those things that I would encourage you to set a meeting with us and talk about a little bit further to see if we can hedge against, and we have many tools, so to make sure that we can hedge against against the interest rate risk as we see that coming down the pike. So I've painted kind of a grim picture, but don't run to the hills. We've seen unprecedented economic activity in the recent times, but we tend to experience change very slowly. So one of those things that we just want to take a proactive approach in retirement, make sure that we see these things coming and that we protect your plan against these risks before they happen and they affect you negatively. So we want to make sure that we can have your plan weather good times and bad, and that your plan is protected no matter what. So even if things, all of these record-setting indicators don't hit us, which we see is probably pretty unlikely, but even if they don't, we still want to protect your plan, because these are inflationary, or these are risks to retirement that we want to make sure that that you don't have to experience to any large effect, and that we can protect you from. So the US dollar largely remains the world's reserve currency. Our treasury bills are still paying returns, so though the global economy and globally, people run to the United States to buy our debt, so our dollar remains largely strong. So we don't need to be too concerned with the value of the dollar going out the window because of that. Interest rates can substantially raise and remain at historic lows. We are very low at a time of historic low interest rates, so even if they do rise 5%, which is huge, which I hope we don't see, because it does have some negative impacts to retirement and the economy as a whole. But even if they do, we're still going to be at historic lows. So people have maintained through those times, and we will too. We are experiencing a global crisis. Much of the world's countries are facing a very similar problem. So when we start to look at our presence on the world stage, we are still better off than many other countries based on this crisis, the pandemic that we're all going through. So again, the key is to prepare your plan to weather good times and bad. Click that link below, set up a meeting with us, make sure that your plan can weather good times and bad, and we'll look forward to talking with you soon. Thank you.